Welcome to Wholesale Investor's Small Cap Virtual Showcase, and get set for some expert insights with our industry panel. Joining us today is James Posnett, Senior Manager Listings Business Development at ASX, Richard Ivers, Portfolio Manager of the Prime Value Emerging Opportunities Fund, and Monik, Kotecha, Chief Investment Officer at Insync Funds Management. First up, as we are at the Small Cap Virtual Showcase, it would be helpful to get an understanding of how the global pandemic this year has shaken up the small cap sector in Australia and where the opportunities are emerging. I may start with you here, James, coming from the ASX. What observations do you have over how this COVID-19 global pandemic has impacted small caps?
Thanks, Lelde. It's quite a big question, so I'll try and keep it very brief for now. But ultimately, on the IPO side, which is where I predominantly sit, we've seen a decrease in IPOs. So we would ordinarily see about 90 to 100 new listings a year. This year to date, we've seen 42. So it's a significant reduction in terms of IPOs, but the real sort of takeaway, I guess, at the moment is, given the buoyant markets, we are seeing IPOs come back, and so the pipeline looks good for the rest of the year. So we can expect sort of somewhere between 30 and 40 new listings between now and Christmas, which is quite exciting. So at a sort of high level, that's what's happened, and lots of the listings on ASX are in that small cap space, as you may well know. On the another feature on the follow-on side, though, follow-ons have gone through the roof, for want of a better term. It's been an incredible year for follow-on offerings on ASX. We've had sort of $46 billion raised across the market as a whole. Now that's obviously small caps, large caps as well, across the board. But it's quite phenomenal. That is number 5 in the world by exchange. So out of sort of 90 or so exchanges in the world, we're number 5 on that basis. And in terms of number of deals, we've had 900 follow-on offerings in terms of number of deals, which puts us number 1 in the world by exchange. Which is quite phenomenal. And again, a number of those deals, yes, there are some large caps in terms of the value raised, but a number of those 900, the majority are small caps doing smaller deals. So that in a nutshell is what we've seen on the listing side.
Well, that's quite incredible growth, given the really this global pandemic and how it has negatively impacted so much of society. How about for yourself, Richard, from a portfolio manager's perspective? What changes have you noticed to the small cap sector this year?
Yeah, it's really upended our views on businesses, really. I mean, we've had to reassess every individual company in the market to determine sort of where they're at. There's been some big winners and some big losers. And, the winners are the obvious things like the tech and online retail, and the losers are obvious ones as well, things like, bricks and mortar retail and tourism. And with those losers, the balance sheets have come into sharp focus as well, because in some cases revenues have dropped to zero. And if they've got debt, it's obviously hard to service that, which is what James was talking about in terms of the capital raising. So it's absolutely caused a complete reassessment of businesses and business models, and it's evolving too, because we're still in the economy is not as bad as it was back in March and April, but we're still going through a difficult period. But then there's sort of some light at the end of the tunnel with the potential vaccine next year, where things could revert, and the losers this year could end up being the ones that rebound the best next year. So it's a real period of flux.
Okay, and Monik, what thoughts do you have, given the pandemic, on the small cap sector?
Yes, well, we run a global equity fund that's clearly more concentrated at the large end of town. Having said that, we obviously keenly observe what's happening at the small end, because a key focus for us is being future focused, and it's really about identifying global secular megatrends. So we have a keen interest, obviously, observing what are some of the emerging trends out there, and usually the smaller companies are at the vanguard at the initial stages of the trend. it's only really later on that the larger companies then get a lot more involved when they see the trend developing, and they obviously have the balance sheet then to invest. So to specifically answer your question around small caps, I mean, I think one of the potential losers, unfortunately, I think longer term, or certainly as a result of COVID, has been the small caps, because the larger companies have had the stronger balance sheets. They have much greater access to capital. And so even where they had smaller competitors coming into the market and perhaps starting to cause some problems, because the balance sheet hasn't been as strong, a lot of their competition has disappeared, and it's really reasserted their strength, the competitive strength of their industry. So obviously there are always opportunities in small caps, you can always find winners. But I think what's happened as a result of COVID is that it's really changed the dynamic, the competitive dynamic in favor of larger companies.
Absolutely. Now, you mentioned mega trends. I'm curious to hear which mega trends you think that small caps are well positioned to capture. Could you give us some examples?
Okay, well, where you typically find attractive opportunities in small caps, particularly today, it's not just only COVID. I mean, the demise of bricks and mortar has been in place for a number of years, as you know. So there's always opportunities there for a new company in retail or a related space to be able to come online and use the technology, use the digital technology to engage with their customers and grow very, very quickly. So I think there's always opportunities across almost any sector for small companies to emerge and do very, very well. And, a lot of them won't have the hindrance of having old legacy infrastructure and old ways of communicating with their customers and all the costs that are associated with that. So as a general comment, I think small companies can still do very, very well almost across any sector, provided, particularly in today's market, that they can come to the market at a much lower cost. They can do it much more quickly, and they can come up with products that can engage with customers a lot more quickly because of social media as well. That's actually brought down, the cost of branding and being able to getting your product and service into the marketplace. But specific to your question, some of the areas that, and again, we don't specifically invest in these areas, but we're keeping an eye on it. Areas that are emerging, obviously around fintech would be one good example, where there's a lot of smaller players that are emerging and really initially started to take the lead. So a good example in Australia would be PayPal. Not PayPal, would be Afterpay, right? And they really created a market very quickly and did very, very well. So I think fintech's certainly one. Another one's telemedicine and telehealth. And again, there's a lot of smaller players that have been around for a number of years, and we believe that trend's now starting to accelerate. So they would be two very interesting areas, I think, for small caps over the next sort of 12 to 24 months.
Okay, and Richard, from an investment perspective, mega trends, sectors, which ones are you focused on for the coming 6 to 12 months?
Yeah, it's things like online retail and technology are the ones that we also see as, the potential big winners. And they've really, what it's done is that it's accelerated their growth or the adoption rates of customers towards those sort of businesses or trends and brought it forward, a few years. Because there's still a question mark, and we're still assessing what the duration of that is, because we're going through such unusual periods now. I'm based in Melbourne, so I'm working from home, and I'm forced to work from home. When we're allowed to go back, it's still a level of uncertainty as to how people will behave when things revert, if it does, and we are successful in seeing a vaccine. But there's definitely been an acceleration, definitely a benefit. It's just the level of that benefit and the duration of that benefit is the question mark, which we're watching and assessing really closely.
Okay, and James, from an ASX perspective, have you noticed that this year there, in terms of sectors, there's been inbound interest from sectors that perhaps are aligned with these mega trends?
Yeah, absolutely. Yeah, in terms of the sort of new IPOs and those on the way, the buy now, pay later space has been very hot. And there's a lot of sort of commentary in the market, of course, about that at the moment. Some people think that the penetration is still relatively low. It's about sort of 8% of online transactions is buy now, pay later at the moment in Australia, and about 1% of transactions in the US. So there's potential upside there. But obviously a lot of players, and with PayPal entering that space and others entering that space, NAB has got a sort of interest-free credit card now. I think it was recently announced. There will be a lot of competition, but the pie is very large. So it will take time to play out, and it'll be quite an exciting area for some time. In terms of, I mean, just generally, we're on Zoom at the moment, and that's obviously travelled very well at the share price in the US. In terms of number of users. So, sort of online communications is something that's, obviously here to stay. It was happening anyway, but COVID has sort of helped accelerate that. And I agree, fintech, e-commerce, SaaS as a very broad category. And then really healthcare. I think, COVID is sort of, obviously there's some more specific companies that are targeting COVID. But we've got, others that I think it really has highlighted the healthcare sector is very interesting broadly. And so I think today on the panel, we've got sort of 3 great recent listings in the healthcare space. And, and that's been really, really good to see. And then, the other trend I think is gold, of course. So gold mining companies taking advantage of the high gold price. That might be temporary, and then it's a very difficult one to predict, the gold price, but certainly it's high at the moment, and that's attracting more interest from them. So I think in terms of sectors broadly, that's what we've seen. And I think really the final one would be sort of data center, like NextDC, for example, storage of data. That's going to be quite critical in future.
Well, it's great to hear the ASX is at the forefront of attracting companies to those with those megatrends aligned with them. I know I just spoke with Neurocare's CEO, and he's also presenting at Wholesale Investor in MedTech, and was saying how excited he is to be listing on ASX. But I want to come back to a comment you said, saying that for the buy now, pay later sector, that the pie is very large, and I'm curious to get Richard and Monik's view on that. And perhaps Richard, starting with yourself, do you think that there still is a big opportunity here to capture when it comes to the buy now, pay later firms? And would you even mention some companies that you like, or do you perhaps, on the other hand, think it's getting to some lofty highs?
Our style of investing is very much a low risk approach and protecting downside. And at the moment, for example, every company in the portfolio is making a profit. And these are great businesses and have done fantastic things and grown very strongly, but it just doesn't suit so much our risk profile of our investors. So we don't hold any of the buy now, pay laters. I know there's 7, I think, listed at the moment. Yes. Which is an incredible amount, and I don't think any of them are making a profit at the moment. And it is getting more competitive. But we do have a strong belief that in investing in the best of breed businesses. And so if you were to invest, if we were to invest in that buy now, pay later, would tend to be attracted to more like the Afterpays and the Zips. Which are the ones that have led the charge and have got scale and a presence in market. So they would be the ones that we would tend to focus on, but they're just not the businesses for us at the moment with our client base.
Sure. And Monik, what are your view on the buy now, pay later firms?
Well, again, clearly Afterpay were very early into that space, and then obviously benefited from that first mover advantage up to a point. But this is one of the key things when you're sort of investing in small caps and looking at early growth companies, is you've got to sort of, it's not only the size of the pie that's important, but it's also the barriers to entry and also the threat of competition as that market continues to grow and evolve, which is why we typically come in a little bit later. We love secular megatrends, but we like to invest in them when they're a bit more developed, and it's becoming a little bit clearer to us as to who the winners are going to be, because our view is that the market tends to undervalue and underappreciate both the durability and the profitability of companies that are benefiting from the mega trend. Once it's become a little bit more, as I said, it's developed a little bit more. Specifically to this area, with PayPal entering the market, and that is a stock that's one of our largest positions in our portfolio at the moment. I mean, they're benefiting from multiple mega trends they're having for a while. There's obviously the move towards the cashless society. As Richard mentioned, there's been an acceleration in e-commerce, and that trend was already very strong, growing well ahead of GDP prior to COVID. And what COVID has done is it's brought forward a lot of years of growth as more consumers have adopted the online experience and become very familiar and have accepted it as part of their life. So we believe that trend will continue for many, many more years. But with PayPal now entering that market, and they've got 350 million customers globally that they're working with, it is going to put considerable pressure on the existing players like Afterpay and others, simply because they can charge a much more attractive fee and still generate a very high return compared to the Afterpays.
Absolutely. And Richard, what do you think about these views yourself when it comes to your investments in the technology sector? I mean, Monik said there that there's significantly more growth in technology. One of my questions was going to be, do you think the growth in a technology small and mid cap will continue? It's clearly got some room to grow, but for how long do you think we're likely to see these gains in the tech sector?
Absolutely. I think the tech sector's got a long way to grow. I think, we can all see that with the way the world's changing and how our own behaviours are adopting to new technology with things like mobile phones, the smartphones. There are a number of very, very high quality business models within the tech sector, particularly businesses like software, which have, recurring revenues where if you think of, like we all use Excel, someone that everyone would understand, something like business like Microsoft, where you use Excel and Office, and you cannot literally not operate your business without that software. So it's incredibly embedded and useful in what we use, and the economic advantage of paying that small fee for that software is very low compared to the benefit that you get. So software particularly is an area we focus on and invest in, and these businesses are going to get stronger and be more and more useful. And one of the other interesting things that's happening at the moment with COVID is it's making a lot of businesses really focus on costs. So we've just come through reporting season. I've probably spoken to 100 companies in the last month, and just about every one of those is focused on cost. And in looking at costs, software and technology is often a way by which they can reduce costs and create productivity benefits. So I think that trend is going to just continue.
Okay, it's interesting you mentioned growth there, because obviously being a private or public company, they're all focused on growth. James, from your perspective, as you speak to companies that are considering listings and obviously speaking to listed companies, how are you speaking to them, or perhaps advising them to navigate in this environment? What do you say when a company asks you, should I go public or should I stay private?
Yeah, there's obviously a lot of considerations there. I mean, this environment has caused some questioning in terms of IPOs, and hence we've seen a drop off in IPOs this year. But actually, most of it has been postponement of the IPO. So it's really, aside from the sort of company specific considerations, obviously market and timing is really important. So a lot of those sort of small cap IPOs are on the way now that were coming earlier in the year before. I think the main thing to think about is, why do you list versus not, conceptually? And I almost find myself going back to 101, why do you list versus not? And it's sort of three reasons really: capital, liquidity, and visibility. And so, with the world awash with private money, we've sort of almost had to go back to basics with some entrepreneurs, because they're obviously great at what they do, but they're not necessarily thinking, that's actually why you list. And it sounds quite basic, but Actually, from there, you can then talk about the actual liquidity benefits in particular. So, the ASX is a great market for follow-on offerings, for example, as we discussed earlier. But, what that means is that you can raise money in 2 days versus, going around and trying to do another private round. So that, for me, the number one thing about listing is the access to capital and the liquidity that you get from listing. Now, you do need to be well prepared, though, as a company. And so, you can come too early. So that's what we're often, discussing with companies, is the timing right? And quite often it's sort of two questions. Am I large enough to attract institutional investment? Is that going to be interesting enough for institutions to participate in that IPO? And am I developed enough to handle the obligations of being listed? So the ongoing obligations of reporting and so on. And also, can I absorb the costs and time that it takes to be listed? Because it's a great thing to be listed, but actually, there are pros and cons. So going through that with the company in detail is obviously quite key. And what that often means is that you tend to wait a bit longer when times are a bit tougher. You'll tend to wait and actually look to raise more money. More is generally better, because you want to be as well capitalized as possible if you're hitting the markets during uncertain times. The market has been quite buoyant relatively. I mean it's still sort of 10% down on the year, but healthcare and tech is up on the year. So it's obviously a sort of two-speed market at the moment. But if you're in the healthcare and tech space, there is still opportunity to list. So the timing at the moment, it is still okay, notwithstanding lots of external risks. So it's going through these considerations with companies. And quite often we're also having new discussions with companies about listing in future, like literally starting the conversation now, which you might sound a little bit unusual, but we are, so it's all layers, all stages of those discussions. And the general mood is it's still conceptually very attractive for companies, but obviously it then comes down to preparing well and getting the timing right.
Sure thing. It's interesting. Earlier in your answer, you said going back to basics. And I suppose from an investment perspective, I'll ask Richard, you describe yourself as a growth at a reasonable price investor. When we look at the basis of your investment thesis, why is this your preferred approach to investment?
Yeah, sure. I guess we talk about GARP and it's really just a way to, pigeonhole some way or communicate the way we invest and our style more broadly. But what we really focus on is quality businesses that are growing and we have a valuation overlay. And by quality, I mean we're looking at management and the sustainability of earnings. We also tend to focus on best of breed in the sector, as I highlighted earlier. With the belief that the best business models with the best customer offer tend to do better over time, particularly, as we've illustrated recently, that business models continually get tested. And so we believe that the stronger get stronger over time, and that is proven out to date with COVID. And then in terms of valuation, we really just think about what's a reasonable person would pay in terms of a multiple for a business. And then we forecast out a few years and look at what that valuation gets us, and then we can do an IRR and work out whether it fits within our 10 to 15% target return. And that's the way we sort of think about stocks more broadly. There's a lot more nuances than that, but that kind of gives you an idea of from a high level. Okay, and can you give me a quick example of a company you're currently invested in that you're a fan of and why? Sure, Lelde. So an example would be, say, Austbrokers is one that we hold at the moment. It's a mortgage broker, it's an insurance broker here in Australia. And insurance, as we all know, is a core requirement. So if you're going to run a business, you need to pay your insurance to continue operating. So it's a relatively non-cyclical business. It's very defensive. And what the insurance broker does, they don't take underwriting risk. So if there's a catastrophe, for example, they don't wear that risk. The underwriter does. So it's a relatively sustainable earning stream, very high cash flow generating. and is getting good growth. We've seen the business model generating sort of 10 to 15% growth over many years. I think I first invested in this business about 10 years ago. And it grows both through organic growth and through acquisition. So it tucks in other insurance brokers and buys them at attractive multiples. And there's a generational change going on within insurance brokers as well. So the older insurance brokers are looking to sell out. So there's fertile ground for acquisitions.
Okay, thank you for that. Now, Monik, you are a chief investment officer, and we mentioned your ability to spot megatrends before also investing in disruptive companies. What's your secret to spotting potential unicorns, and where do you think the next one will be?
Right. Well, the core to what we do is investing in megatrends, and the beauty of megatrends is they generally have less sensitivity to GDP. So with COVID, for example, we had to make very few changes to our portfolio to what was obviously a very disruptive and dislocating moment in the economy and in the market. So that was the pleasing feature, because megatrends tend to be very enduring. They tend to be very long term, unstoppable, and very large markets at the end of the day. So as I said, one of the ways we seek to invest in a lot of companies is the fact that many investors sometimes look at the businesses that we own and say, look, they look a little bit overvalued on the short term, but what they're undervaluing is the sustainability, the durability, and the speed of growth that's actually taking place, and that doesn't get picked up in any sort of long-term valuation model. So the secret, there is no single secret in a sense. It's obviously some art, a lot of data gathering, and looking for evidence to corroborate, a lot of the information we're thinking about when we're thinking about that particular megatrend. The size of the market, the speed with which it's growing. So we collate a lot of data, and we make sure that it's consistent across the board, so we have a high degree of confidence in it. And it's only once we get to that point and we can find a really attractive business model that's clearly demonstrated high levels of profitability and good capital allocation. So they're reinvesting, and every time they reinvest into the business, the incremental return they're getting on every dollar is very, very high. So sometimes with early startups in the early phase of a mega trend, you see a lot of customer acquisitions taking place, but not a lot of profitability and cash flow growth. Whereas in our businesses, we see a lot of very high levels of profitability. We're starting to understand who the winners are going to be, and then we can get behind them and back them. Obviously monitoring valuation, but it's really the long-term valuation we're much more interested in. So that's really the art of sort of identifying these mega trends. And I think the other thing is, because we're so focused on it, it's a core part of what we do. We have a very experienced team doing that. We're doing it for multi-decades, each of us. It just means that you just get better and better at spotting them and working out which ones are at a stage where we can invest and which ones are perhaps we're a bit too early. We just need to keep an eye on a bit more.
Sure thing. Well, look, it's been great to speak about all of the opportunities that are currently present in the market, especially amid all the negative news that we're receiving and have received this year. I'm curious, perhaps as a final question as well, when we look forward, to hear what you're most excited about, in whether it comes to the small cap sector or mega trends. What excites you about the current future of investment or listed companies? Perhaps starting with yourself, James.
Yeah, look, I think what's most exciting to us on the listing side at ASX is the fact that we've got some great momentum in both technology and foreign listings on ASX. So the past 5 years, we've effectively doubled the peer group in tech listings. We're at about 270 now in that sector. We also launched the ASX S&P ASX All Technology Index in February this year, which was a bit of a tough time to launch an index, but I'm happy to say it's well above water for now, at least. And that's, that just gives a little bit of, I guess, higher profile to those companies. Globally, it's got the S&P name attached to it as well. And in terms of the foreign listings, we're at about 250. So a number have been from New Zealand. We've got sort of 58 from New Zealand, and that's effectively doubled in the past 5 years as well. You can tell there's a theme here, but I think the momentum of this is going to continue on ASX. And the other thing that excites me is that, yes, we've had a good sort of run of tech listings. A lot of them have been in the small cap space, but a number have really matured. And so you've got to a point now where the sector is about 140 billion, which is roughly sort of 6% of the market. Now, 6% doesn't sound like a lot, and I'm really thinking from the perspective of there's plenty of upside. So it's actually come a long way, but there's plenty of upside to go. We continue to look around the world for opportunities, and the US is quite exciting as well. We found in the US market, it's kind of interesting. Certainly in the small cap space, you're really, when you're pitching an ASX listing, you're actually pitching against private markets in many cases. So a company could be running a Series C dual track, doing a Series C round, and then looking at ASX at the same time. We've managed to attract a few interesting companies that were doing just that. So Limeade, for example, SaaS business from Seattle, came last year. And we've also attracted interesting companies like Fineos from Ireland, which is in the SaaS space, or insurance software space. And so those are interesting opportunities for the Australian market. And I think it really just validates more the homegrown technology companies that the ASX is a really good avenue for raising capital. Now, there is obviously the right time to raise capital, and we are quite sensitive as to when that is, as I touched on before. And, it really does vary. And I sort of hesitate to sort of say, anchor people to numbers. But when we think about the institutional investment interest, it comes, around that sort of raising 20 million on 100 million valuation, for example. And what does that mean? It means to revenue maybe of sort of 10 or 20 million. In the tech space, just generally. But again, it's hard to anchor to numbers, because actually, if you think back, Xero listed when it was a $50 million company, Afterpay listed with revenue of $250,000. So I want to just caveat those numbers as well. But what I'm really trying to say here is that, for small caps, ASX is a fantastic place to be. And it's also, related to index inclusion, of course. You can enter an index far earlier here than you can on other markets, say the NASDAQ market. So you're entering the sort of all ordinaries index at about 150 million market cap. The ASX 300 at about $300 million US market cap. And if I compare that with $11 billion US market cap to enter the S&P 500, what we find is that there's a real opportunity here, because many companies that would maybe in the old days have looked at a NASDAQ listing are looking either to private markets now, because you need to be a sort of $1 billion plus business to really get traction on NASDAQ these days. But, as you can imagine, there's a lot of companies below that level. And then it goes back to the old arguments: when do you list, when do you not list? And so the attractive thing is that listing still, even in this world of private capital being awash, is still attractive. So I think in terms of the future, I'm quite excited that interaction will continue to play out. And it's not necessarily, it's not to say we compete with private markets only. It's actually complementary, of course. So early private money goes into companies, and later there can be a liquidity option down the track in terms of IPO instead of late stage. So these things are going to be quite interesting going forward. And in short, I just think that momentum of tech and cross-border listings is quite exciting and will continue.
That certainly is very exciting. And Richard, from your perspective, what's exciting you about the future of small caps?
Yeah, I think I echo James's views about the small cap sector here in Australia. I think it's really matured. I've been in this market for about 17 years. It's really matured and got the quality and depth of businesses in the small cap market has improved significantly. And the other interesting thing that's happened is that a lot of Australian businesses have been successful going global. You know, I remember 10 years ago, if you went global, it was seen as a risk and your PE would get derated. Now it's actually a positive, and a lot of businesses have been successful. And we've got a lot of quality small cap businesses that are really succeeding overseas. The likes of City Chic and Redbubble, two companies we hold. So that's an example, and echoing what James says. But what excites me too about now is that we're in this period of flux, and as a stock picker, that's what you want. You want periods where things are changing and evolving. We do an active company visitation program and had a lot of experience doing it. So in periods of change, it kind of plays into our strengths. In ability to pick stocks and pick on new trends and businesses that are going well. So we're really excited about the outlook and how things are going to evolve over the next 12 to 24 months.
Fantastic. And finally, Monik, over to you. What's exciting you for the future of small caps?
Well, as I said, we focus on large caps, but I am actually really excited about the future. There is so much innovation going on today. And, this is I think we've started the process, but this really is the decade of innovation. And I think what we're going to see within the ASX, for example, these are obviously my own personal views, is we're going to see an evolving structure from the old to the new. In the US, we've already seen that. There's obviously well-established, large capitalized technology companies that make up a large part of the benchmark. And I think we're going to see a similar thing in Australia where, a lot of the old businesses that were starting to be disrupted, well, what COVID has done is accelerated the disruption. And what we're seeing now is a rapid growth in new technologies, which is going to, I think, change our lives for the better and create a lot of wealth in the process. So we've already spoken about a lot of the spaces, but it's technology. It's, we're really excited about digital health, for example, because, what we now have is a collision of trends that is really going to drive the growth in digital health. So we've obviously got great success around gene sequencing. We've got machine learning, and then you combine that with the emergence of 5G. And what that basically means is that for a 60-year-old patient, for example, who was suffering from a history of heart failure, there was a poor understanding of his disease, there was very poor compliance, and the diet and medication wasn't appropriate. And we're now going to move into the digital space where that same person is going to get a personalized health plan that's really tailored for that individual's need, with all the education, the nutrition, all the maintenance of the medical records will be up to date. So when you go and see any specialists or doctors, that information is at hand immediately. There is no lag in time, so it can be very effective in terms of providing the right quality, advice. And, there's going to be a lot more proactivity and surveillance. And interestingly, the whole process is actually going to also lead to a reduction in healthcare costs. We know healthcare costs is one of the largest costs borne in almost any country, any developed country around the world. And, there could be a potential 60 to 70% decline, when you've got better surveillance. Basically, it just stops that individual from having to go to the hospital and the expense that comes along with that. So, very, very excited about innovative companies. These are real companies that can gain profitability very quickly. This is not like it was 20 years ago. And so talk about the ASX, I'm actually really constructive. And I think as a small cap, if I was a small cap manager, I would be keeping an eye, perhaps more than I would have 20 years ago, these emerging companies, because if you don't, they're going to, as we've seen in the recent past, they grow very quickly and they become mid caps. And before you know it, they'll become a large cap much more quickly than perhaps was possible 15, 20 years ago.
Absolutely. Well, James, Richard and Monik, thank you so much for your insights today. Certainly lots to be excited about for the future, and it's been great to have you all on the panel today.
Thank you.
Great. Thank you.
Thank you.